This isn't live, right? Edwin Cass, Chief Investment Officer. What you've had is central banks trying to put pressure on the system through raising the overnight rate to drive output back to trend. And that's not a buy the dip kind of mentality. For the last 10 years, we've had to keep overnight close to zero to try and stimulate the economy. From an investment standpoint, that's not a great starting point because you've got real rates at zero or negative. Fast forward to where we are right now, real rates are positive. That's a better starting point for putting money into the market. In terms of go forward expected returns, it actually feels better to me now than it did, say, a year ago or 2 years ago. I think anytime you get radical change in the market, and we've definitely seen episodes in the last year that we haven't experienced for a long time, I think it's interesting. In a lot of ways, though, what we're seeing in the markets right now, I'd say is more akin to what I'm used to than what I wasn't used to. I think that's true for a lot of us that have been involved in the markets for a long period of time. This kind of feels normal to me in the sense that you've got a relatively normal business cycle force going through the economy. I think the last 10 or 15 years prior to, let's say, March of last year were the real abnormal episode where you had overnight so low, where you had risk-adjusted returns so low, where you had real rates so low. That was interesting too, and interesting for a different reason. If we don't get a recession, then we think it's highly unlikely that you get that easing. Now, if that's the case, then you probably have to reprice bonds. But I think it also has a knock-on effect to stocks because I think stocks are looking for that support from the bond market to sustain a rally. If yields have to go up further or if yields have to stay higher for longer, that's going to be a real challenge to equity markets. We actually hit our long-term target of 80% active just before the start of COVID. That has necessitated a big change in terms of our thinking, and specifically that's trying to change that deployment focus to one where we think about investing across the entire life cycle. So that's not just deploying capital, that's also asset management. Can we take advantage of investment thesis related to value creation within particular companies to try and make them earn more, to improve their profitability? It also focuses us on being able to sell assets where the investment thesis is already played out. Strictly from a portfolio construction standpoint, you're trying to manage a risk that isn't within the data set right now. So you can't look back to a prior period and say, look, the investment portfolio is subjected to a whole bunch of climate change risk. What assets performed well, what assets didn't perform well in those environments. We're having to kind of create the machinery around that analysis as we go right now. We have a number of initiatives there. A lot of them look at top-down considerations, taking a look at physical risk, taking a look at regulatory or transitional risk, as well as innovation risk, and trying to first measure those risks and the impact they could have on our portfolio. And then secondly, and I think this is where it gets really interesting, trying to figure out if we can manage those risks. So through our portfolio management, through our signaling to our different investment departments, how can we control those risks within bounds that we think are kind of acceptable in the sense that they don't jeopardize the overall sustainability of the fund?